Hi guys and gals, welcome back to Eighth Wonder Investing. I hope you're all well and ready to absorb some more investing knowledge. I know I am. Phil Town, he has three main valuation methods that he teaches and practices in his books, in his podcasts and teachings via his workshops and webinars. I'll be sharing with you today the margin of safety valuation method as a way of calculating the intrinsic value of a stock. The way Phil Town describes it is the margin of safety is kind of more aligned with a typical Wall Street method, valuation method, where one discounts future value to today's price in order to come up with the intrinsic value and what price to pay today. It is similar to a DCF, to a discounted cash flow, in the fact that you are projecting where the company's value will be in 10 years. And then you're discounting this value back to today at your minimum acceptable rate of return, or MAR, and then taking a margin of safety off of this. In a DCF, we take the summation, the total of these cash flows that we grow out over a period of time, plus a terminal value, and then we find the net present value of the total of all of those values using our required rate of return. But that's a DCF. The margin of safety is similar. In the margin of safety valuation, we are using a future multiple of earnings to arrive at a share price, and then calculating what you would need to buy the company for today to make sure that you make your required rate of return between now and then in 10 years. It's a subtle difference, but it's very similar methods. Aside from the 10 cap method, this method requires that you make two assumptions about the business: a cash flow to start with, and then a growth rate with which to grow that cash flow. And what we use for the margin of safety, and what Phil teaches, is to have an understanding of a company's earnings and figure out today what level of earnings should you start with, and then look back in the past at historical growth rates of those earnings, and then coupled with your understanding of the business and how that growth might play out in the future, you need to come up with a growth rate as well. So this growth rate we call our windage growth rate. It's a term, as far as I'm aware, coined by Danielle Town, Phil's daughter, while he was teaching her in their podcast series. The windage growth rate, it's like a finger in the air to detect the wind kind of way of determining the growth rate. You look at how the company has grown its cash flows in the past and take an estimate of that growth in the future. You do this as well with some understanding from your own research of how those cash flows are likely to grow in the future. If you don't have that understanding of how the earnings might grow in the future and what they may look like, then you shouldn't really be doing this analysis and coming up with a buy price. You should really get back to the research, or either put it in Warren Buffett's too hard pile that he has on his desk. And we don't have to be super conservative with that growth rate because we're going to be hammering the price with a margin of safety at the end. But we can't be too enthusiastic either. So we have to find a comfortable middle ground for the company's growth of earnings. And this growth rate will apply for the whole 10-year period that we do the margin of safety valuation over, the whole of the 10 years for that element of cash flow for the earnings. And it should reflect an optimistic but achievable growth that the cash flows of the business can achieve. So this is how Phil Town teaches it, whereas this differs from a DCF, where you can have kind of whatever growth rate tagged to each individual years that you want. So I'm just going to go jump into my spreadsheet and take you through an example of this. So see you over there. So we are over here in my spreadsheet, where I'm just going to walk you through an example of the margin of safety valuation method. This is one of the valuation methods that Phil Town teaches in his classes, in his books, in his podcasts. And we're just going to be using Apple for today. Everyone knows who Apple is, and they've got relatively stable financials. So they should work okay for what we want to use this for today. Right, so let's get stuck in. So one of the first things we need is we need to have a relatively good understanding of what Apple's earnings are per share today. And that's going to act as our start point, our foundation to grow the earnings from there. So you can get that in a few places. You can go to Yahoo Finance and to get the trailing 12 months earnings. You can get it from multiple sources. One that I like to use is a site called Macro Trends. So you pop in the ticker, go to price ratios, and the first one it takes you to is PE ratio. And then scroll down, and we've got this middle graph here shows us the trailing 12 months EPS, but over time, and actually, for the last 12 years here. So we can see how volatile these EPS numbers are. We can see that if we'd be choosing one which is an anomaly, wildly high for that quarter, or wildly low. But we can see Apple's earnings are growing steadily over time, and even in the last year or so, they have been growing, steadily, although a bit faster than in the past. So we're going to take this figure here, $6, for our first input. So we pop 6 in there, and then we need to do two other things. We need a growth rate and we need a PE. So we'll start with the growth rate. So we're going to put in two numbers here. We're going to put in a growth rate that you can try and determine yourself based on your analysis by looking at things like return on equity, return on invested capital, the historical growth of earnings, of revenue, PE, of free cash flow and operating cash flow. And you can try and come up with the growth rate yourself that you think over the next 10 years that Apple can grow at. So I mean, when I did this, I came up with 17.5%. But then we need an analyst growth rate as well. So the way Phil Town teaches it is, he sees that the analysts, they spend a lot of time researching a company, and who are we to think that we know better than them? You can find an analyst growth rate in a few places. I like to use Yahoo Finance, and you pop in the ticker, go to the analysis tab, and then there's a table that should appear, and then at the bottom under growth estimates, we can see next 5 years per annum, it's just over 10% the analysts are expecting. I also like to pop over to a site called Zacks, where again, pop in the ticker, and then what they give you is expected EPS growth 3 to 5 years, 12.5. So we got just over 10, just over 12. I think because they've had, because from my research, I was coming up 17.5. I'm probably going to use 12 here. And then what we use for this windage growth rate is the minimum of the two. So we build in a level of conservatism here. So we're already undercutting the growth rate that I had predicted from my research by using the analyst estimate. So we're going to grow the earnings out into the future, but we need a PE to use in the future. So we're going to put in two PEs here. One's already been calculated, because if you don't know what the historical PEs have been, and one kind of proxy you can use is, or that Phil Town teaches, is 2 times the growth rate. So with a windage growth rate of 12, 2 times, we can put in 24 here. But then again, we can go back over to macro trends, and this bottom graph, we can see the PE ratio over the last 12 years. We're going to ignore this kind of euphoric stage here, where PEs seem to go above the long-term trend. I mean, tech stocks did very well in this 2-year period. Low interest access to money with the Fed putting interest rates at zero and pumping the economy full of cash. But we can see the 10 years prior to that, we actually remained relatively stable within the range of 20 to 10, and back up to 20. So I think we'll use 15 for this. The numbers can be adjusted, you'll see later on, but I think we'll take an average between 10 and 20 of 15 for this PE. And again, I've got a little formula in here to calculate the minimum of the two, because we're going to add in a level of conservatism to find the minimum. And then what we can do, we can start, there's kind of a quick way of doing it and a more manual way. I know some people like to see how their calculations and how the numbers are changing as they step through the calculation step by step. So we'll just do that first. We'll start with the earnings of year 0, it was 6. And then we'll start to grow them out into the future. So we'll take these earnings and we'll times them by 1 plus our windage growth rate. So that's basically 112%, which we times the earnings by. And actually, I'll just lock in that windage growth rate value. So when I drag across, we're all good. So drag that out to 10 years. And then that gives us Apple's future earnings, assuming our assumptions are correct, that they will be earning $18.64 per share of earnings in 10 years. We can then convert that to a stock price because we have a PE, and if we multiply those earnings by our future PE that we've determined, we can get a stock price of about $280. So assuming Apple's earnings are $6 per share and they grow at 12% and they trade in the future at 15 times earnings, that's what their stock price should be. But we're obviously not buying it 10 years in the future, we're buying it now. And one thing we need to add in is our minimum acceptable rate of return. So this is the rate of return that you want to, that is like, you don't want to accept anything less than this. Over a long period of time, investing in index funds like the S&P 500, including dividends, has returned you about 10%. So if we can't get, meaningfully more than 10%, then why wouldn't we just invest in an index fund? So Phil Town uses 15%, and I use 15% as well for this. And he also uses 50% margin of safety, and I like to at least start there, 50% margin of safety. So we pop those in. So then we can take this future stock price, and we want to know what we want to buy it for today, so that between now and 10 years' time, we make a minimum of 15% per year. So we take stock price and we divide by 1 plus our minimum acceptable rate of return rate. Lock that in. So that we can drag it back to today's date and get a stock price that we should buy it for today of about $70. But we don't want to pay that, do we? We don't know if our analysis is correct. We're going to make many errors in judgment over the years, and to allow for the, as Charlie Munger calls it, the vicissitudes of life, we're going to take a massive margin of safety. 3 of the most important words in investing. So we'll take that price, times it by a margin of safety, to get a very decent price to buy Apple for, about $35 a share. And if we buy Apple for $35 a share, then we can, nothing's guaranteed, obviously, but we can be highly confident that we will at least achieve 15% rate of return, and likely achieve more. And in the very worst case, along with Warren Buffett's #1 rule of investing, which is don't lose money, and the reason Phil Town's fund is called the Rule 1 Fund, we don't want to lose money. We want to avoid a permanent loss of capital. So that's what we're trying to focus on here by having our minimum acceptable rate of return at 15% and a massive margin of safety. We do not want to lose money. We want to focus on the downside and let the upside take care of itself. So the quick way of doing all this is we want to know the future value. So we want to get to this $280 figure over here. So we go FV, future value, our windage growth rate, number of periods is 10 years. Payment amount we skip for this. This is if every period or every year you want to have a payment in or out. We don't. And then present value, the way this formula works, has to be a negative number. So we'll take those earnings and times them by -1 and get our future EPS, earnings per share of 8. $18.64. Then we can calculate the future stock price, which is that our earnings, future earnings by the future PE, again about $280. And then to calculate our minimum acceptable rate of return buy price, we then want to take the present value, so PV, present value of that future stock price. So the rate is going to be our minimum acceptable rate of return. Again, 10 periods for 10 years. Ignore the payment amount and our negative value of the future stock price. So times that by -1. And we get to the $70 figure, and then again times that by a margin of safety to hammer it down to $35. Whether Apple will get there, that is up to your judgment. This is just an example. This is not financial advice to go out there and start buying Apple at $35. I think it'd be pretty tough to do that at the moment anyway. It's just an example of how the margin of safety valuation method works. You can play around with these numbers. If we actually take the 17.5% growth rate and we assume a better PE, for example, maybe 20, we get out different numbers. We have to be careful with this because the bias is if you get a really low number and the stock price is not near it, you think, oh, well, maybe I can, maybe I was wrong. Maybe I can adjust some of the numbers. You'll be amazed what stock prices can do when everyone out there is fearful. Okay. And you want to remain on the side of conservatism, and you may never get to buy Apple, but this won't be the only company that you're looking at. And if Apple did get down to the $35 range, you would be able to act with confidence, knowing that you were already conservative in some of your numbers. So that essentially is the margin of safety analysis. So that's it. The margin of safety valuation method that I first learnt from Philtown as a way of calculating the intrinsic value of a stock. It's one of a few that I use. I do use the margin of safety today. The margin of safety, it's a good method when the cash flows of the business are relatively stable and they can be reasonably predicted out into the future. It is not so good, however, for calculating intrinsic value of every business. For example, doing a net asset value approach to determining what to pay for a stock, like I've done with some of my other investments. But check out my other videos for details on some of the other valuation methods that you can use, which you can add to your arsenal of ways to calculate intrinsic value for a stock. So you can end up with a range. And if all of those values are kind of pointing to the same number, then that can give you extra confidence that you're in the ballpark of where intrinsic value actually lies. Well, I hope you've enjoyed learning about margin of safety valuation today. With that said, get out there and give it a practice, and let's all become super investors together. So I will catch you on the next one. Take care.